As an example, for those of you who might not be familiar with what externalities are, they're kind of economists' special term for costs that the company doesn't have to pay for that do impose harm or costs on other entities. So let's use Exxon as a pretty typical example. Let's say Exxon emits a lot of emissions, as in fact they do. And the costs of climate change accumulate because one share of that does come from Exxon's emissions, and the costs of that end up applying to pretty much every other company in your portfolio. So if you view it that way, you have to actually think, how do I reduce those externalities? Not how do I just not own the companies that are adding those externalities, and it gets much more complicated than that. So we'll dig into some of the complexities, but basically it's the idea that you're responsible for everything. You have to kind of try to manage the commons, so to speak, if you're a universal owner, and there's no way to stock pick your way out of it. And there are a lot of other examples other than climate change, everything from antimicrobial resistance to inequality to climate change and biodiversity. It can apply to quite a number of different areas, and it's kind of nice because it's also where I think our moral intuitions would lead us, but it's also purely logical. So if you are trying to reduce the risk that your portfolio faces from climate change, you are better off doing that by protecting the entire system by working with others than you are trying to narrowly avoid some of these costs in your own portfolio, because it's basically impossible to do that. Try imagining what sorts of stocks you could hold now that would survive untouched until 2050 if the worst of our climate estimates come to fruition. I mean, there's no imaginary portfolio that would meet the standard available. And also, and this is kind of critical for universal owners, most of your returns don't come from outperforming. They come from the performance of the market as a whole. So, and finance folks will call this beta and alpha. So alpha is what the term people use to describe when they are outperforming the market. And that's usually a relatively small percentage of your returns overall. Most of your returns come from the overall market movements. And that really allows you to switch your mindset. I actually think this lends itself really well to effective altruism thinking, because there is already this implicit assumption that we want to try to maximize positive impact and hopefully think holistically and systemically in doing so, because otherwise you can end up in a situation in which you're trying to kind of maximize or optimize for one thing, and it actually has an unintended consequence elsewhere that you can't properly account for with typical approaches to ESG. And what I might do now actually is just to embark on a fundamental critique of the current approach to ESG, because I hope that'll help illustrate why universal ownership might have at least the seeds of where we might want to go in this field. So, and we will use climate change as the example, I think, because that is the focus of your group. And by the way, I'm totally stoked that your group has been working in this way, because I do feel like climate has been historically neglected in the EA community, and I'm just so delighted that you're addressing that. And this speaking series is such a great example of that. So yay and thank you. But yeah, let's get into what the typical approach is and why it doesn't work, and then hopefully that kind of helps reflect back on universal ownership. Because I also just want to acknowledge something else, which is that universal ownership is an idea that needs ironing over. Often people need to hear about it in a couple of different ways. So if you're feeling right now like you're starting to get it, that's really good, and we'll go over it enough more times in the next 45 minutes, such that it's hopefully starts to kind of click. But yeah, let's talk about ESG for a minute, because most of it is crap. And that's probably the most important thing you need to know. And it's probably crap for reasons that you would have guessed, just as regular critical people assessing the kind of lack of advancements that we've made on this critical issue. But it gets much worse than that. So I think many of us, without having steeped ourselves in this area of work, we would look at the average ethical fund or ESG fund and say, oh, it's weird that this company is in there because they don't seem very sustainable to me. And we would look at that list of companies as our indicator as to whether greenwashing was taking place. But it actually gets to a much more fundamental level. So my research has been looking at basically where impact comes from in the financial sector. And so like, what allows a company to grow, to invest in new infrastructure, be it fossil fuel infrastructure or green infrastructure? You know, what is kind of driving expansionary activities, but in both ways? And that is quite there's a stark answer, actually. If you buy and sell shares, you are buying and selling them between and among existing shareholders, because they're already listed on the stock market. So if it comes, let's say when Exxon first listed on the stock market, and by the way, this is a terrible example because Exxon was like the bastardized child of like Imperial Oil and so on and so forth. So it never listed on the stock market in its current form, but whatever. Let's say Exxon listed on the stock market in the first place, it would actually get the money from selling its shares at that moment when it listed on the stock market for the first time. But after that point, its shares would be sold in the secondary market, what's called the secondary market. And then it really didn't affect Exxon when those shares were sold. The money didn't go back to Exxon. It was flowing between and among those shareholders, as were the shares. Right. And I do want to just emphasize one thing here. I'm not insulting the divestment movement in saying this, because I actually think they are very, very important, and we shouldn't discount the social discourse effect of divestment, especially for name brand institutions that have a lot of cultural power. I think divestment is actually the way to go, even if it involves selling shares, because it's how we tend to get legislation that's effective in our societies. We don't tend to legislate things until they're viewed as wrong or problematic somehow. And so the stigmatization effect of divestment is actually, I think, quite an important mechanism for achieving some of the legislation that we need. And I think a lot of us probably think that ultimately regulation and legal mechanisms are a big part of what's required to solve climate change. So that's just one mechanism in which it's kind of a circuitous effect. But my research suggests that there has already been a social discourse effect from the divestment movement, and that really shouldn't be discounted, even though it is. I know EA folks, we like to be able to measure things. We're not going to be able to measure that with great precision, but that's okay. We shouldn't discount it for that reason. We should accept that that is part of this a very complex picture of how we'll get to where we need to go. Anyway, so sorry, that was the longest caveat ever, but I just wanted to make sure that we don't kind of throw out the baby with the bathwater. Divestment is a very important social movement that it has definitely helped with this whole picture. But let's say you're a non-name brand institution. Let's say you're an enormous pension fund no one has ever heard of, and there are a lot of those. And if you think about how that actually controls or where control of overall financial markets comes from. These pension funds and sovereign wealth funds own a ridiculous proportion of all financial assets, especially when you consider that they hire the fund managers who are also enormous. And if you think about the way in which they could affect fund managers' behavior by working together to kind of enforce standards at that level, you really do conclude pretty quickly that it's all about pension funds and endowments, sovereign wealth funds, insurance companies, basically those enormous blocks of capital that control a lot of different people's money all in one pool. So anyway, when we look at that, we might think actually it makes sense for these entities to hold on to their shares and deploy them as effectively as possible. So if you're going to own a share, you should be voting against directors. because there's a lot of debate in this area, and I just want to acknowledge that there needs to be more evidence collected and ways of studying shareholder resolutions, because I think somewhat similarly, they probably have a social discourse effect over the medium to long term, and they affect how conversations go within companies and within the broader kind of financial media sphere, etc. Probably has a reflective effect on regulation to etc. But if you're looking at trying to get an individual company to change its behavior in the shortish term, you want to do something quite different, which is vote against the re-election of directors. And that what's interesting is, so to explain why shareholder resolutions can't normally achieve that kind of outcome, I'll just give a few reasons why, while also acknowledging there's some jurisdiction-specific complexities as well. But so most big companies that are emitting a lot are listed in the US, and those companies are governed by the SEC's regime there, which means that if you're going to get a shareholder resolution brought to a company's annual general meeting to be voted on. And yes, absolutely, I can totally speak about engine one, number one, and Exxon. Let's stick with the example too. Yeah, this is good case study. So the types of resolutions you can usually get through the filter of the regulator in the US tend to be the sorts of resolutions that don't ask for much. So they tend to be oriented around the risk to your portfolio, again, not the impact that your portfolio is having on the real world, it'll be more about disclosure of risks from a company. So let's say Exxon would be asked to disclose their scopes 1, 2, and 3 emissions, as opposed to actually asking that Exxon decrease its emissions, right? So there's very, very different types of asks, and the latter is not likely to make it through. So you're already quite significantly narrowing the types of things that can be voted on. And then it gets worse from there, because most of these resolutions fail. They do not hit the 50% threshold. Even if they win, they are purely advisory in most cases, which means that they can just not be followed through with. And this is evident when you look at the implementation rate, which tends to actually still be quite poor. So you end up with these resolutions that are usually disclosure only, and they won't even necessarily be implemented in any case. So that is quite depressing, right? If you look at shareholder resolutions, you have to think there are other things probably that they're bringing in terms of discourse, normalizing certain asks and so on and so forth. But again, you want to get companies to move fairly quickly. So what do you do to make that happen? You vote against the re-election of directors, because you don't even have to win in a lot of cases to make it more likely that a company will behave the way you want them to, because it is embarrassing for high status individuals like directors of major companies to be voted against in any kind of numbers. So if you look at, I mean, this is sort of an automatic vote in a lot of cases. A director will be accustomed to getting like 98% of the vote. So if they get 89% of the vote, that's actually hugely embarrassing. And there's also this fear that, you know, I could lose this position next year, right? So it kind of puts the focus on shameable individuals who are, you know, very esteem reliant. As high status individuals. They're kind of named, individualized, and therefore much quicker to respond when they have that kind of shaming mechanism deployed from major investors. So it's really quite, good point, Alex. Yeah, it is kind of just most people or most investors end up automatically voting with management. So that's the default, and when you're trying to do something else, you're fighting that default, which can be quite difficult just for reasons that I think we're all familiar with, just heuristics and, you know, defaults matter. I think we all know. So that's absolutely critical. So that's what you want to do with your shares, right? So that's ownership. This is what we all I think talk about until we really dig into this area. We're all talking about shares, and we're thinking about ownership of companies, and logically we think that affects companies, right? Which companies we own, it either helps or hurts them if we do or don't own them. I think we talked hopefully a bit about why that's not the case. Those shares are swirling about in the secondary market. Doesn't really matter which one is owned by whom, as long as they are voting in the most effective way possible. But I think is absolutely critical then to turn to is these other asset classes where there is genuine impact and additionality. So that I think probably the number one thing to remember out of this whole discussion is that about 90% of new financing for fossil fuels comes from debt. So the bulk of that is bank loans. And then there's also bond. So basically debt that is in the form of, and I'll maybe just explain a little bit for anyone who's not in the finance realm. So if I buy an Exxon bond, that they've kind of created financial instruments through an investment bank, let's say. When they sell a bunch of bonds and I buy one of them, I am basically lending money to Exxon. So I know that sounds kind of bizarre, but when you buy a bond, you are lending money to the company. And it can be countries as well. I mean, there are a lot of different kinds of bonds, but bonds are debt instruments. And when you purchase one, you are lending money to the company. And that's where these companies, other than their own cash flow, so a lot of companies are able to fund plenty of new fossil fuels through the money that they make from selling fossil fuels. But when they're going to outside investors for new money, it is overwhelmingly debt. And that is something like I'm going to emphasize that over and over again here, because that is something I think that is missing from this space and that we absolutely need to pay close attention to. In fact, I often found, until relatively recently, that if some pension fund or university endowment had made a commitment, a divestment commitment, an ESG commitment, it almost always only applied to their public equity, not their debt portfolio. And it's like the opposite of what they should be doing, right? I mean, I hope we can kind of think through what we've discussed already about ownership of shares and realize that by just selling your shares and not even doing the kind of effective voting against directors that's available to you and not paying any attention to your debt portfolio, you were probably just rearranging deck chairs on the Titanic. I mean, I do think announcements help when it comes to divestment. I almost don't care what a small investor does when they make a big deal out of it, because it is a social discourse thing. But it's very frustrating to see people leave aside the main source of new financing for fossil fuel expansion by ignoring debt. And just to dig into that a bit more, where is this debt coming from? Who's investing in it? It's very much about banks. And actually, yeah, so what percentage is Canadian banks versus, okay, very good question, Alex, and please do feel free to just throw more questions in. So the biggest financiers of fossil fuels are large American, Canadian, and Japanese banks and Chinese banks. So there's actually a great report that's put out every year that I highly recommend that you look into. The latest one is called Banking on Climate Chaos, but they put it out every year, and it's got the latest one is now expanded to 60 banks. And so you can look at the top 60 financiers of fossil fuels globally. And that covers both direct lending and underwriting. And underwriting is really talking about facilitating the sale of bonds and IPOs, initial public offerings. That's when a company lists on the stock market for the first time. Again, that's new money. So again, it can kind of help a company grow. Thanks, Alex. That's great. Yeah. So definitely click on that link and explore. So okay, Jared, I'm gonna read your question. Okay. Oh man, what a great question, Jared. Okay, I'll just summarize quickly what he said here. Basically, many EAs have links to some of the universal owners we discussed today. And especially probably pension funds, I'm guessing, but some academic institutions will have endowments as well. And how do you kind of, how do we bring this to these sorts of entities? First of all, I mean, these entities don't tend to hear from very many people, like even about basic ESG crap. By the way, I'm not insulting the people who are writing to them about it, because it's not reasonable for a layperson to understand why ESG is crap, because it doesn't look like it initially, right? But the people who they're writing to in the pension funds will know that it's, well, should know that it's not very effective. So they'll actually be surprised to hear from people who understand this stuff. And I actually think that because there is so little direct pressure on these types of institutions, you'd be surprised what 5 emails a year can do, especially if they're well thought out and with more of an impact orientation, because I think it's a lot harder to dismiss then. I've certainly found that, especially with academic institutions, because you end up with people who have chosen to work in an institution that works from the evidence, and they are very quick to dismiss things that they don't think are particularly useful. But if you come to them with something that's well reasoned, that does typically seem to help. Also, I love that what you've written here, Jared, seems to imply that you already understand this to quite a significant degree, which is really helpful when you have those follow-up conversations with the people in question. But yeah, I would recommend maybe reading up a bit about it so that you could even have a conversation if need be, but also just seriously writing an email to your pension fund or university endowment can be, especially on the pension fund side, they just really don't hear from people very often. And frankly, banks are the other big target / lever. So I've started to do some work with the various colleges at Cambridge. So they all have their own banking relationships, but they also invest in banks via their fund managers. So there are a whole bunch of different ways you can get at these institutions. And it can, you might be banking with one of these very fossil heavy banks. They are starting to worry about people switching banks. If you do so, tell them why. I have it on good authority that Barclays Bank actually missed out on a statistically significant chunk of the demographic that was young and in university during the apartheid South Africa fight, because a lot of people switched banks because Barclays was still undertaking banking activities in apartheid South Africa, and they actually lost so many people. And people switch bank accounts less often than they switch spouses. So, you know, they're very sticky, which, you know, a term some of you might be familiar with. So it's actually quite scary for banks to start seeing any kind of significant shift in bank accounts, because they know they'll never get them back. And that's true for institutions as well. So if I were to pick a few things to work on, I would recommend getting your institution to switch banks publicly. And there are a lot of bank accounts floating around. So just, you know, I know a lot of institutions are very different from Cambridge, but just to give a couple of illustrations, the students groups all have their own bank accounts, some of which aren't even tied to the central college or university bank accounts. And some of them have been switching even where there is a current tie between the two. You've got yes, all sorts of student societies, student government. You've got accounts through community groups, faith communities. I mean, there are a lot of different accounts around, and therefore a lot of potential to actually shift some of the discourse around this, hopefully in doing it publicly and having told the bank why. Yeah, good pro tip from Alex there. I'm just going to try to come back to some of these comments here. Okay, so Kushagra, am I pronouncing your name correctly, by the way?
Yes. Right.
Yes. Okay, good. So that's a very interesting. So I actually have a bit of a critique of Make My Money Matter, because that is making assumptions about the impact of selling shares, which again, we've kind of discussed, you know, really not additional. So I actually don't trust that precise calculation, but I do think more broadly, shifting how your pension fund is invested, and critically shifting the default fund, not just your own pension, because that's tiny, but actually shifting whole pension funds, that's probably the by far the most impactful thing that we could work on.
Sorry, what does default fund mean? What does that mean?
Oh, thank you. And please do keep any clarifying questions, please keep them coming. The default fund is basically where everyone ends up being invested unless they specifically choose something else. So for example, my pension fund through the university, I'm just like in the vanilla fund, and then I can choose to pick what's called an ethical fund. It usually isn't, by the way. But what you want to do is change the standards for the entire pension fund, because only usually like 2% of people will actively choose anything but the default fund. People pay a shockingly small amount of attention to their pensions, which I'm sure we can all kind of sympathize. I think about it less than I should, given my role and research. My own personal pension is not my primary focus. I think a lot about pensions, but I think it's probably a bit of a blind spot for many of us. So again, that's why it can be more effective to put pressure on them, because they don't often hear from people. But also, if you were even able to get them to shift by a tiny amount through a bit of time spent with a few of you working together, let's say in the same institution, that's a pretty good input-output ratio of time and effort in terms of impact. So hopefully that.
So how would that work, getting them to shift? Can you just say, hey, can you shift the default? And they'll be like, yeah, no problem? Or like, has anybody done this?
Well, so okay, also a great question, because there are a whole bunch of different ways you can go about this. I mean, I very rarely see people say, yeah, no problem. But usually after quite a bit of wrangling, there can be some potential for a shift if the ask is reasonable and accepted by the other beneficiaries, especially. So if you've got a group that, has a particularly strong concern about climate change, let's say you've got a teacher's pension fund or medical professionals, et cetera, like those groups just tend to have an overwhelming concern about this topic. So you can kind of make the argument that this is what beneficiaries want. And if you can demonstrate that there isn't significant financial detriment, then that gives the pretty clear legal basis for doing stuff. And then you just want to make sure that it applies to the bond portfolio and private equity and other asset classes, and that they aren't just doing some greenwashy thing by applying some crappy ESG screen to their public equity. That's just critical. I'm just going to come back to the questions here, just in case there are things I've missed. Okay, so how about the angle of financial risk disclosures? Okay, so also a great question, because I think that we would all assume that what's being disclosed is what the impact that company or portfolio is having on climate change. But again, it's the opposite. It's what are the risks that that company or portfolio faces from climate change. So you could imagine actually some pretty counterproductive things happening, because the best way to protect some of your real estate holdings might be to build giant concrete berms to protect them from sea level rise, right? And that could actually be quite high emissions. But what we would, I think, prefer, probably all of us as more impact oriented folks, would be disclosures on the impact that a company is having on climate change, so that can be reeled in. I'm actually quite skeptical about disclosures more generally, because I can't find a reliable link between improved disclosures and improved environmental performance itself. And so disclosure isn't even remotely enough. I think it should be asked for as a means to another end. So prove that you've actually done this action by disclosing that you have done so in the following way, as opposed to just asking for disclosure as the ultimate ask. That just doesn't seem likely to produce any kind of real world change. Okay, how have you been able to apply this work in your role as advisor to the CFO at Cambridge? How's their divestment journey, and what are their plans with their assets? Also a great question, and very complicated to get into, but I'll take a quick stab. So I routinely engage with fund managers and banks with the colleges at Cambridge. So there are 31 colleges and their own endowments, each one, plus the central endowment, plus a bunch of other weird endowments that are just kind of hanging around. So one of the departments has an endowment, the scholarship funds have endowments. And so we kind of coordinate those and do collective engagements that are more likely to get the attention of the fund managers in question. And because it's an educational institution, I think there's some legitimacy there, which means that probably we're too small to have the kind of influence that we're in fact seeing on those institutions. And we're asking impact-oriented questions when they normally get asked things like, what's your climate disclosure like? Things like that. That's not what we're asking. We're being a lot more focused on debt, voting against directors, those sorts of things. And really focusing on banks in particular. With Cambridge, I think the divestment journey was sort of, I wrote a report with 2 co-authors about the advantages and disadvantages of divestment. And basically, I think what that did is allowed the university to conclude that the cultural influence of a well-respected educational institution meant that it was probably the right call for us to divest very publicly. And we put a lot of effort into getting a lot of headlines out of it. And that was kind of recognizing from the research that that was a very important element of divestment. Like if you divest and don't tell anybody and you're not that big, no educational institution gets to the size of these big pension funds, even Harvard, which is enormous. And Cambridge is the largest university endowment in Europe, but it's still, that's not that much money in the scheme of things. It's more the influence and effect on social discourse. So that was kind of the thought process that emerged from the research. And if you are curious, the divestment report can be read online. I think James is maybe going to put it in the chat, and it's not as long as it looks. So it's about 50 pages itself, and then there's some appendices, but the appendices actually get into the evidence around what are effective forms of shareholder engagement and what is the potential additionality by asset class according to the evidence we have now. So just if you want that kind of background evidence, that's all there in the report. Sanju, you've asked another question here. How should people strategize to pressure the SEC with climate finance regulations? Awesome question, and one that frankly I don't think I can answer properly, because the problem with a regulator like the SEC is that they probably are only going to be, their mandate doesn't really cover climate action so much. But one thing would be to require that companies actually disclose the impacts that they're having on systemic risks, not just climate, but antimicrobial resistance, inequality, et cetera, and some of these other, basically anything that relates to the SDGs or things that could kind of affect the whole system. That would be marvelous, and going much beyond just the impact that a company has, the impact that these risks have on companies, which is just too narrow a focus for universal owners. By the way, I hope you're starting to think of yourselves as universal owners, because the more I think about this, okay, awesome. Because the more I think in this area is, anybody who's under 60 now is statistically likely to be alive in 2050, and climate, if unchecked, could become terrible for everyone. Sorry, you already know this because you're here. And therefore, if you have any investments at all, you're a universal owner. And by the way, there are some equity issues there that we need to get into as well, because there are a lot of people in the world who do not have any investments to invest. And that's something we need to take into account when we act as universal owners. I actually think we need to have a moral mindset that kind of takes into account the fairness that can be kind of enforced through the financial system and big pension funds and other universal owners to help even things out, address climate change and other things that actually disproportionately affect the people who had the least to do with causing it in the first place, et cetera. So I think that's another big element to return to. EA wrangling sounds like a new cause area. Oh, I like it, Alex. Yeah. Ivan or Ivan? Which way do you pronounce it? Is it Ivan?
Ivan, but
Okay.
Feel free, whatever.
Cool. I'm just reading your question here. Yep, that is true. So, and in many countries in general, companies get subsidies. It can take the form of grants or funding, but also, yeah, direct subsidies or tax breaks or whatever else. There is a separate body of research on that. I'm not particularly an expert in it, so I can just tell you that that's real, yes, and it's not just the EU, it's pretty much everywhere I can think of that these subsidies, implicit or otherwise, I mean, technically building roads and other infrastructure that serve internal combustion vehicles. I mean, that's actually, I mean, you can get pretty far with subsidies and think through the ways in which we spend public money. But yeah, no, that's totally a critical element, and there is a lot of research on it. Alex, can you help me wrangle the Ontario Teachers Pension Fund? Okay, so yes, let's follow up on that. Yeah, I've had some discussions with them actually. Yeah. Jared, would you recommend that those of us who invest in the S&P 500 index funds start vote by? Okay, this is a very interesting question. Thank you. So basically, what form of index fund should we buy? Because I think, yeah, index funds make the most sense in terms of keeping your investments low cost and just getting a representative slice of the entire economy. I'm not that pleased with the types of fund managers who offer ETFs or index funds, because a lot of them, even if they have a special fund that votes your shares appropriately or allows you to do it yourself, the way that they vote their bulk assets, it typically runs counter to what we would all want. And that's a pretty big issue. So one thing I might recommend is seeing what is available by looking at their voting reports in different markets. So Voting Matters is the one you'll see Share Action does every year, and that covers some US funds as well as quite a bit more coverage in Europe. Majority Action tends to put out an annual report in the US on the voting activities of major fund managers, and those are the ones that tend to offer index funds. And that's the way that you can kind of make it more likely that you will have your shares voted the way that you might wish. Although I will also add the caveat that it's not yet in people's awareness to vote in accordance with universal ownership theory. Because again, the implication of universal ownership theory is that you might actually prefer Exxon to make less money. Because if they maximize their profit seeking, that actually ends up kind of de facto maximizing the emissions that they will contribute to the rest of the economy. So there are cases for a universal owner in which you would prefer a company to do less well than it could otherwise, because you want them to reduce the externalized costs that they produce. And that's you don't tend to see any fund managers thinking that way yet. So even, you know, ESG voting advice from the proxy advisors are unlikely to direct anyone to vote against the kind of narrow financial interests of any company, even when that would decrease the externalities that company is imposing. So that's actually something really critical and maybe something that needs to change. So let's maybe try to push for that as well from fund managers and the proxy advisors they take their voting advice from. Okay, also a great question. Okay, so this is, are we better off targeting the biggest banks or the smaller ones? So I have noticed and would love to see some work on this, but I think you don't tend to see a lot of fossil fuel financing by smaller banks because they're not big enough to do the big syndicated loans. So those, I think it's probably even more of it. It's probably more than an 80-20 kind of impact split in banking. It really is. If you look at that report that was referred to earlier, the Banking on Climate Chaos, it really drops off. Like the top few banks really account for a lot more lending and underwriting of fossil fuels than the ones lower down the list, and that's only looking at 60 big banks globally. So just imagine how much that, you know, how weirdly thin that tail is going to be, and how huge the bulk is at that top end. So I think I would recommend going for the big banks, because I doubt that credit unions or smaller banks are really doing much fossil fuel lending, even proportionate to their size. So it really will be the big ones. But that's a really good question, and I'm not 100% sure that I'm giving you an accurate answer on that. That's just what I would say based on what I've seen thus far. Sunny, thank you. Yeah, we'll oh yeah, and James has linked to so that the ones that James has linked to there in response to Sunny's suggestion is the divestment report, the first one. The second one is my kind of plain language guide for maximum impact as an investor on climate and other systemic social and environmental issues. If you read that and you find things that are not plain language in there, please let me know. I am impossible to offend. But let me know if things are not clear and I need to explain them better, because I would absolutely love that kind of direction. Other questions? Right, votes link, So I don't tend to offer investment advice in terms of precisely whether you should invest in Vote, the engine #1 thing. I personally, the jury is still out for me as to whether engine #1 is going to contribute to genuine decarbonization efforts, because the 3 candidates who made it onto Exxon's board, and sorry for anyone who's not familiar with this, basically there's this kind of amazing effort to replace board members at Exxon that was quite unprecedentedly successful. They got 3 new members appointed to the board, or voted onto the board, and against the wishes of management, which is wild. I can't tell you how unusual that is. But I'm not actually sure that even all of those new directors are really committed to decarbonizing on a 1.5 degree trajectory, for example, right? So they're going to be better than the existing directors of Exxon, which frankly isn't hard, and likely will do more what's called capital discipline. So probably a little less investing into new exploration and development of new fields and so on and so forth, which is good. But whether they would actually invest on a trajectory that we would want is a separate question. And I don't know how firm or strict or science-based engine #1 is going to be. So I hope that they will be. And in that case, I might begin recommending that people buy into their ETF, because I think it's a good model, doing that kind of universal ownership approach of being responsible for the behavior of the companies in your portfolio. But I just don't know if they have gone that far yet and are going to have the kind of strictures in their model that we would want to see. Yeah, and then there's stuff about the oil price. Yeah, there are so many questions there because there are pluses and minuses to oil and gas companies with either very high or very low oil prices, depending on especially where they are and so on and so forth. But yeah, that's pretty complicated. I think we can expect to see a lot of volatility is probably the only thing that we can say with some certainty around oil prices, because we tend to be pretty bad at predicting them to a high level of precision. Right, why do banks syndicate fossil loans? Is there a leverage point there? Great question. It's because it's sort of too much risk for one bank to cover a whole big loan, right? So that's why they go in with a whole bunch of others. It's kind of their own form of diversification, really. And I do think there's a leverage point there, because if we can get a bunch of banks to agree together not to go into syndications without certain conditions being met, then, because I think right now there's a bit of a collective action issue. You have a company, like a bank would have to kind of agree to get less revenue for itself, and know that probably at least some of what they were going to do would be backfilled by others, probably at a slightly higher cost, by the way. If you have less availability of capital in the debt markets, you actually can see an effect on the cost of borrowing, which is, I mean, that's really interesting. It means that you could end up with what's called a higher hurdle rate for new projects. So you would probably do fewer new projects that didn't look good according to the numbers if it cost you more to borrow the money necessary to do that project. And a lot of fossil fuel projects are now more expensive than their renewable energy equivalent. So, you know, you can actually start to see some things happening there. But yeah, I would say, as with so many things in this area, you want to see more collaboration within different players in the sectors, because it does seem more likely that a company would agree to turn into a runoff company, for example, as an oil and gas company, instead of remaining on a growth trajectory, if 5 of their major banks got together and said, we will continue to lend to you only under these conditions. So that's the sort of thing you'd want to see, as opposed to trying to get individual banks to forego revenue. That's a difficult ask for a number of reasons that I'm sure we can all understand very well. Yep. Yeah, Jared, your point is totally correct. Yeah, they are an improvement, the new engine number 1 directors, but they can only get Exxon a certain amount of the way there. And also they have a lot of other pressures on them to maintain Exxon's health as a company. I kind of think that change in this case is not going to necessarily come from the new directors, but a bunch of very large investors saying, these are the sorts of minimum standards that we're applying to all companies in a sector, so that Exxon isn't at a disadvantage relative to others who, undertake to halt new exploration activity or whatever else. So I think there's something about universal ownership applying the same standard across a whole sector, so that, and actually, if you think about it from a kind of humanistic standpoint, if you assume that people in positions of power in these companies or fund managers or wherever else care somewhat about the planet and other people, it should be a relief to them to no longer have to compete on the basis of, using child labor or, paying their workers poorly or emitting a lot of CO2 into the atmosphere. Having minimum standards should actually be a relief to people who would actually rather compete on other things and not have to slip below those kind of minimum standards. So that's one way of thinking about it. Another question here. Are there any major asset managers who are interested in the idea of universal ownership, and what seems to be the biggest barrier to adoption? Fantastic question. There are actually several very large pension funds who self-identify as universal owners, which is very helpful, because if you look at norm formation literature, that's actually a very critical part of all of this, is having high profile initial backers. We have that with universal ownership, but I would say true implementation has a number of barriers. One is the coordination issue. So getting enough players together to vote against directors such that it actually is a meaningful threat, and especially debt denial. So, not purchasing the debt of companies that are violating these minimum standards. There hasn't been enough coordination around that either yet to see real change on the part of the companies or changes in cost of capital. But I mean, that can definitely happen. It is a coordination issue. Should a really rich EA like Sam Bankman-Fried, how do I pronounce that? Anyway, buy a big oil and gas company to transition it off carbon? Not a terrible idea, actually. There are huge complexities here, including geopolitical complexities that we don't need to get into now, because although I don't subscribe to the view that Saudi Arabia and Russia will just pick up all the slack and that those are government-owned companies that we don't have control over, I still think we should decarbonize all of the oil and gas companies that are publicly listed and in Western countries. That I think that still needs to happen too. But I think we probably just need to be careful that we're not encouraging companies to sell off assets to other entities that will just continue to run them, often with higher emissions. So that's something we need to manage quite carefully. But I actually think it'd be what I'd love to see is a private equity fund that went around and sucked up oil and gas, like the kind of struggling shale entities, and ran them down. Did a kind of managed runoff scenario with them, and turned the land into land trusts, to make sure that no one else could go drill, decommission the assets, etc., and kind of like permanently retire that source of emissions. And actually, I believe Bloomberg went and bought a whole bunch of coal plants and did something equivalent to this in the US, and actually did manage to shut down quite a few coal plants. So yeah, I mean, if very wealthy people were to do something like that, I think it would help. Also, there is a misconception out there that you need to just worry about demand for fossil fuels, but really it's a supply and demand picture. You can't have ever expanding supply and expect demand to go down, because oil then is too cheap, basically, to provide the impetus to switch to other sources of energy. So you do have to handle both sides. So actually, I do think that would be a smart thing to do, frankly. to get a very wealthy person to start spearheading something like that. And also, frankly, we should be getting investors in the very large oil and gas companies to agree to a runoff scenario. It's psychologically very difficult because I think no one wants to run a company that's on its way out. You know, especially someone who wants to be a CEO of a major company, probably psychologically is not well suited to that kind of role. You know, captain of a sinking ship, but probably where we need to get to. Has this already happened with tobacco companies? For example, do some banks refuse to work on their debt issues? They have way less of an issue on the debt side. Again, I mean, it's actually crazy if you look at the evidence on so-called sin sector companies like tobacco and alcohol and so on and so forth. They resort to debt markets disproportionately because they know that people are only focused on shares. So it's actually another great example of the way in which we need to change our focus to have an impact where we see the history of companies that have no social value, like tobacco companies, causing a lot of harm and resorting to debt markets so that they can continue their operations. But yeah, great point. Yeah, I love, private equity to buy shale resources and convert them to geothermal and regenerative agriculture. Yes, yes, and yes. Goody, hi. Is the runoff PE option just a cost to the PE firm, or can it be at all profitable? Okay, great question. And there's some research on this. So basically, it's quite likely that companies that are on kind of a growth maximization trajectory are not optimizing their returns either. So Carbon Tracker Initiative has done some great research on this, suggesting that unless oil prices remain quite high on average for many years or decades, it'll actually make more sense for oil and gas companies to go into a managed runoff pattern of investment. So basically, instead of spending new money on exploring for new fields or building new infrastructure, just exploiting their current fields and gradually running them down actually makes more financial sense for a lot of the different future scenarios that we would see in terms of oil prices. So that, I mean, that is fascinating, and it actually allows you to think of ways in which you could get universal owners to work with other investors who don't have that recognition of systemic issues, because they might just think, well, that's the best way to profit maximize, period. You don't have to have any other concerns. So that's kind of interesting.
You'd get a spike in the, like, you get a spike in the current fossil fuels in the market, right? In that scenario.
So you
No?
You would probably, so I think it depends on what happens for non-market fossil fuels as well, right? So like again, the Saudi Arabia and Russia examples, and what they do has a huge role to play in what the oil prices end up being. But you're actually more likely to see sort of a predictable oil price if a lot of these companies go into managed runoff and we transition at the kind of pace that we need to go. Although I have to say, if you see demand decrease even slightly ahead of schedule, you'll see what we got under COVID. Remember how demand decreased by what, 7% or something like that because of lockdowns, and then the oil price just completely collapsed. And if you think about what's going to happen with electric vehicles, it seems unlikely to me that with the way things currently work, that we wouldn't see a kind of similar crash in oil prices / huge volatility and so on and so forth. So this is totally without any basis in fact or knowledge, but my guess would be that you would see actually a more stable price of oil in a scenario in which more oil and gas companies took that kind of measured runoff approach. But yeah, great question. And then this last question here, do you think that universal ownership is a meaningful vehicle to have impact? Do you think impact from this is comparable to donating? So the good news about universal ownership is that you should do it and donate as you would normally, because I don't think anyone's recommending that you take money out of pension funds. Like that just kind of makes, you should keep your money in your pension fund. That makes a lot of sense for a number of reasons. It's, you know, collectivized pooled assets, very low cost for individuals to take part in, blah, blah. But you can influence how those behave. So do whatever you were already doing on the donation side. And then in addition to that, spend a bit of time and pressure your banks and pension funds and university endowments and others, any other blocks of money you know of, including wealthy individuals, whomever. That's just additional. So I don't think it has to detract at all from other efforts in this sphere, but great question as well.
Cool. I think, should we wrap up there, Ellen? Have you got any closing remarks before I do a tiny spiel to close?
I have a finishing question. So do you have some resources that make it easier for individuals to pressure their banks, pension funds, or any block of money that they have access to?
Very good question. My team and I should have that, to be honest. Although it would probably be a bit transparent because we also directly engage with a lot of these funds and banks and so on ourselves. But there are other organizations. I'm trying to remember. One of them I think is called Switch It. There are a few of these, but those are websites you can go to switch banks and some other service providers. So I would start there. And then for pension funds, you could go to Make My Money Matter, but maybe just alter the text that they provide you with and make sure that you add some stuff around director votes and debt, particularly, you know, focus on bond portfolio for a pension fund. But yeah, no, those are great questions. And that's probably the easiest and fastest way to do it. So that makes it most worthwhile for you to do it yourself. Yeah.
Cool. Good final question, Seb. Yeah, I put it in the chat. Switch It Money. Actually, my friend works there, and yeah, they're pretty cool. They do some good stuff. And yeah, Share Action, I guess, another similar one. Yep. In terms of closing stuff, I'm going to put a few final links in the chat. But yeah, thank you, Ellen, so much for your time. This has been super interesting. And yeah, we even ran late. I don't know, all the questions keep coming. I was like, oh my God, this is so interesting, more and more. So yeah, I think this has been really useful. And in terms of future talks, I'll send an email with a few of them links that Ellen shared in the chat, I shared in the chat, and a few like the companies or the people you can reach out to for more information and wider reading. And in terms of staying up to date, there's the Effective Environmentalism website. You can sign up to get the newsletter, find out about more talks. You can join the Facebook group if you want to, again, more discussion-y, forum-y stuff, and again, stay in touch. But also, if you feel like you want to give a talk like this, or you know someone who might want to give a talk related to climate and effective altruist related stuff, can be as loose as you want it, as long as it's like vaguely on the right lines. Just reach out to me by email. My email's in there, and also Ellen's email is just there as well. So I guess any more technical stuff on universal ownership, that's your person.
And do feel free to reach out. I'll just apologize in advance. My inbox is a dumpster fire, and it might take me a while to respond. But particularly if you have a line into you know, large pension funds or anything like that, I would really love to help you and maybe to connect you with some people I might know who are already working on a particular pension fund in question. So yeah, thanks so much. It's been an absolute delight to hear all of your wonderful questions and have this discussion. So thanks so much, and hope it was useful.
Yeah, and good one. I will try to download the chat and get all the relevant links out and pop them in. So I will try to make that work. But cool. Thanks, everyone. Have a nice rest of Sunday evening, and thanks all for coming. See ya.